pleasure today to introduce my colleague, Professor James Livingston, who has been very helpful in the online work that I've been doing. Earlier, when we did a history in the news class, and he spoke about specific economic issues that we had lots of economic crashes been happening the last couple of years. But here we want to look much more generally at, because this is a course about 21st century crisis, and we're looking at Wall Street, and the comparison is going to be with where Dante put bankers in the Inferno.
Yes.
And so maybe we'll pop up a few cartoon images for students, but they won't be as horrible as the fate of the bankers. And we're also probably going to take on some of the alchemists who tried to turn ordinary metal into gold, and Dante didn't think much of them either, and they're even further down in hell.
They're further down than the bankers?
And yes, they're another level below. And so we're going to connect that to what we think about Wall Street and making money out of nothing. Indeed, at some point I'm going to interrupt our video here and use it's about a 10-minute teaching clip which tries to explain things that are very hard to understand, like derivatives, and who's buying and what that could possibly mean.
Good.
And it's related to a specific crisis, the 2007 housing bubble collapse and so forth. But with you, I'd be very happy to explore more broadly the nature of the 21st century and its vast economic inequities, which are partially addressed in a book that very proud to have a colleague who's written Against Thrift, Why Consuming Culture is Good for the Economy, the Environment, and Your Soul, which you can tell by the title gets at the wonderful spirit that Professor Livingston approaches all these matters with. But why don't you tell us first about, when did you come to Rutgers? What got you, maybe even before that, what got you interested in history or intellect? It's really intellectual history as much as economic history. And what you teach that students might be able to study with you.
Interesting. I came to Rutgers in 1988, and I was hired as someone who could teach economic, labor, and business history. And but I'd always been told by colleagues before I arrived at Rutgers that I really didn't teach economic history. I taught intellectual history. That is, I was more interested in the ideas that economic actors, people in the marketplace, had about the marketplace than in the statistical profile, say, of the marketplace as such. Always more interested in that. So they always said, well, that's not really economic history because it's not about this thing over there that we call the economy, which is a force unto itself. I always doubted that claim. I always thought that economic change was a function of social movements and social change, and by their very nature, social movements are saturated with, they're determined by ideas. So I guess I always was, in that sense, a closet intellectual historian, and that's been my trajectory since I arrived at Rutgers. I've taught less and less economic history, more and more intellectual and cultural history. But when the crisis hit for real in 2008, in September and October of 2008, I got a lot of anonymous emails from people who had read a book that I wrote back in the 80s. It was published in 1986. It's called Origins of the Federal Reserve System. They said, you wrote the book on the Fed, why don't you explain this crisis to us? And so I did a two-part piece called Their Great Depression and Ours. And I compared this crisis to the Great Depression of the 1930s. And I said that the comparison stands, and I explained this current crisis in the terms that I had done before in the 1994 book. I explained it in exactly the same terms as I explained the Great Depression. I don't know if you want me to go into that explanation.
Can you tell us? Yeah,
okay.
I'm all on pins and needles. So.
Okay. What happened beginning in the 1920s, and this is for the first time in human history, actually, you could begin to extricate living human labor from the production process, from goods production, without any loss of productivity or output. In manufacturing, transportation, construction, there was a net loss of 2 million jobs in the 1920s, and yet the output of the industrial sector was up somewhere around 60%, and productivity overall was up about 40% for the decade. So, remarkable figures. with net losses of jobs. Meanwhile, in the aftermath of World War I, there was this massive transformation, or I should say massive transfer of income shares away from labor, away from wage-earning labor, to profits and dividends, particularly amongst the large corporations. The difficulty in the 20s for the large corporations was that even as all of this income was accruing to them, the profits rose approximately 52% over the course of the decade. Dividends more than 50%. The problem was that there was no need for corporations to invest this new surplus of profit in goods production because the labor force had become that much more productive in the course of the 1920s. So, and they didn't. They didn't have to. They could increase productivity, they could increase output without reinvesting all of these funds that were suddenly available to them. So they did what any rational CEO would do, these corporations. They turned those surplus profits over to the bankers. And the bankers invested in the stock market. There was no prohibition against that kind of investment in the 1920s. There wasn't, in fact, until the Glass-Steagall Act of 1935, if I'm not mistaken. That, in other words, banks could not directly invest in the stock market. So that redistribution of income, I argued, caused the Great Depression.
October 29th, 1929, Black Tuesday. The New York Stock Exchange is in a panic. Frantic investors have scrambled to unload their stocks at any price. Everyone wants to sell. No one wants to buy. Suddenly, even the most gilt-edged securities are practically valueless. The stock market crash has come, and the Great Depression has begun.
Because it was in the 1920s, for the first time, that consumer goods were actually the leading industrial blocks. So that at the very moment that you had increased consumer demand for these new consumer goods industries, there was this massive transfer of income away from labor towards capital. Meanwhile, capital could do nothing, as far as I can tell. They acted on rational grounds. They could do nothing except speculate in the stock market. Industrial corporations were speculating on their own account in the stock market. They had $6.6 billion in what was called the call loan market, where loans could be yanked from the borrower at any, at a very short notice, within 24 hours. So I took that as my template, and I explained the Great Recession, as we now call it, of 2008, and continuing into our own day, in exactly the same terms. From the 1970s on, there has been, as we all know by now, this increasing inequality and huge transfers of income shares away from labor towards capital, and exactly the same thing happened. Because they didn't need to reinvest these profits, these new profits, in increased capacity, they could increase output and productivity without such investment. They didn't invest. Instead, they handed their money over to the bankers, and the bankers did what they do best, find more and more lucrative markets, which were, of course, turned inevitably into bubbles by the midpoint of the first decade of the 20th century.
The crisis of credit, visualized. What is the credit crisis? It's a worldwide financial fiasco involving terms you've probably heard, like subprime mortgages, collateralized debt obligations, frozen credit markets, and credit default swaps. Who's affected? Everyone. How did it happen? Here's how. The credit crisis brings two groups of people together, homeowners and investors. Homeowners represent their mortgages, and investors represent their money. These mortgages represent houses, and this money represents large institutions like pension funds, insurance companies, sovereign funds, mutual funds, etc. These groups are brought together through the financial system, a bunch of banks and brokers commonly known as Wall Street. While it may not seem like it, these banks on Wall Street are closely connected to these houses on Main Street. To understand how, let's start at the beginning. Years ago, the investors are sitting on their pile of money, looking for a good investment to turn into more money. Traditionally, they go to the U.S. Federal Reserve, where they buy treasury bills, believed to be the safest investment. But In the wake of the dot-com bust in September 11th, Federal Reserve Chairman Alan Greenspan lowers interest rates to only 1% to keep the economy strong. 1% is a very low return on investment, so the investors say no thanks. On the flip side, this means banks on Wall Street can borrow from the Fed for only 1%. Add to that general surpluses from Japan, China, and the Middle East, and there's an abundance of cheap credit. This makes borrowing money easy for banks and causes them to go crazy with leverage. Leverage is borrowing money to amplify the outcome of a deal. Here's how it works. In a normal deal, someone with $10,000 buys a box for $10,000. He then sells it to someone else for $11,000. For a $1,000 profit, a good deal. But using leverage, someone with $10,000 would go borrow $990,000 more dollars, giving him $1 million in hand. Then he goes and buys 100 boxes with his $1 million and sells them to someone else for $1,100,000. Then he pays back his $990,000 plus $10,000 in interest. And after his initial $10,000, he's left with a $90,000 profit versus the other guy's $1,000. Leverage turns good deals into great deals. This is a major way banks make their money. So Wall Street takes out a ton of credit, makes great deals, and grows tremendously rich, and then pays it back. The investors see this and want a piece of the action, and this gives Wall Street an idea. They can connect the investors to the homeowners through mortgages. Here's how it works. A family wants a house, so they save for a down payment and contact a mortgage broker. The mortgage broker connects the family to a lender who gives them a mortgage. The broker makes a nice commission. The family buys a house and becomes homeowners. This is great for them because housing prices have been rising practically forever. Everything works out nicely. One day, the lender gets a call from an investment banker who wants to buy the mortgage. The lender sells it to him for a very nice fee. The investment banker then borrows millions of dollars and buys thousands more mortgages and puts them into a nice little box. This means that every month he gets the payments from the homeowners of all the mortgages in the box. Then he sicks his banker wizards on it to work their financial magic, which is basically cutting it into 3 slices: safe, okay, and risky. They pack the slices back up in the box and call it a collateralized debt obligation, or CDO. A CDO works like 3 cascading trays. As money comes in, the top tray fills first, then spills over into the middle, and whatever is left into the bottom. The money comes from homeowners paying off their mortgages. If some owners don't pay and default on their mortgage, less money comes in and the bottom tray may not get filled. This makes the bottom tray riskier and the top tray safer. To compensate for the higher risk, the bottom tray receives a higher rate of return, while the top receives a lower, but still nice return. To make the top even safer, banks will insure it for a small fee called a credit default swap. The banks do all of this work so that credit rating agencies will stamp the top slice as a safe AAA rated investment, the highest, safest rating there is. The OK slice is BBB, still pretty good, and they don't bother to rate the risky slice. Because of the AAA rating, the investment banker can sell the safe slice to the investors who only want safe investments. He sells the OK slice to other bankers, and the risky slices to hedge funds and other risk takers. The investment banker makes millions. He then repays his loans. Finally, the investors have found a good investment for their money, much better than the 1% Treasury bills. They're so pleased they want more CDO slices. So the investment banker calls up the lender, wanting more mortgages. The lender calls up the broker for more homeowners, but the broker can't find anyone. Everyone that qualifies for a mortgage already has one, but they have an idea. When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered if the homeowners default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages. This is the turning point. So, just like always, the mortgage broker connects the family with a lender and a mortgage, making his commission. The family buys a big house. The lender sells the mortgage to the investment banker, who turns it into a CDO and sells slices to the investors and others. This actually works out nicely for everyone and makes them all rich. No one was worried because as soon as they sold the mortgage to the next guy, it was his problem. If the homeowners were to default, they didn't care. They were selling off their risk to the next guy and making millions, like playing hot potato with a time bomb. Not surprisingly, the homeowners default on their mortgage, which at this moment is owned by the banker. This means he forecloses and one of his monthly payments turns into a house. No big deal. He puts it up for sale. But more and more of his monthly payments turn into houses. Now there are so many houses for sale on the market, creating more supply than there is demand, and housing prices aren't rising anymore. In fact, they plummet. This creates an interesting problem for homeowners still paying their mortgages. As all the houses in their neighborhood go up for sale, the value of their house goes down, and they start to wonder why they're paying back their $300,000 mortgage when the house is now worth only $90,000. They decide that it doesn't make sense to continue paying, even though they can afford to, and they walk away from their house. Default rates sweep the country, and prices plummet. Now the investment banker is basically holding a box full of worthless houses. He calls up his buddy, the investor, to sell his CDO, but the investor isn't stupid and says, no thanks. He knows that the stream of money isn't even a dribble anymore. The banker tries to sell to everyone, but nobody wants to buy his bomb. He's freaking out because he borrowed millions, sometimes billions of dollars to buy this bomb, and he can't pay it back. Whatever he tries, he can't get rid of it. But he's not the only one. The investors have already bought thousands of these bombs. The lender calls up trying to sell his mortgage, but the banker won't buy it, and the broker is out of work. The whole financial system is frozen, and things get dark. Everybody starts going bankrupt. But that's not all. The investor calls up the homeowner and tells him that his investments are worthless. And you can begin to see how the crisis flows in a cycle. Welcome to the crisis of credit.
Okay, now, Tom, I understand that a corporation like Apple, which I like some of their products, don't they have, I'll be foolish and say I don't know whether it's $6 billion or $600 billion, but some fantastic amount of money that they don't, it's just in cash is what I heard.
Exactly.
Like it's under the mattress.
That's right. That's right.
So you don't get any interest, so it can't be. What does that do?
Well, that's a really good question.
How does it get in the hand? No, I'm thinking of all these people
Well,
globally.
precisely. I mean, one of the arguments of the book is that, look, if we want to have balanced growth in the future, not these constant crises and bubbles, which we've had since the late 80s, since 1987, it's been a boom-bust cycle. If we want to do that, we need to redistribute income away from capital towards labor. In other words, stop these ridiculously inflated profits and these ridiculously inflated salaries for the CEOs and try, using the tax system in perfectly legal ways, to reward working people for what they do. Real wages, median family income has been stagnant since the late 1970s. I mean, there's been no movement there at all, which is to me a scandal given the increases in productivity that the workforce has brought to bear. Apple is not an exception. In fact, Apple is, I think, part of a broader trend that Martin Wolf, particularly of the Financial Times, has been noting since approximately 1998, 1999. And that is this huge, Alan Greenspan did it as well, by the way, while he was the Fed chair, this huge discrepancy between retained corporate earnings on the one hand and what we call business investment on the other. That is non-residential private investment. Huge discrepancy. The gap has been growing to the point where the Organization of Economic Cooperation and Development wrote a report on this phenomenon, this huge gap between retained earnings, in other words, what Apple's got to the tune of $6 billion, and the investments that these companies are actually making. And that gap has been growing to the point where the OECD issued a report in 2009, I believe, that Martin Wolf then cited, saying that this is unprecedented. And the volume of cash we're talking about is trillions of dollars, not just billions of dollars, trillions of dollars. So, my question would be then, why? I mean, how did this huge surplus get generated? As far as I can tell, that's the tax code. We keep cutting taxes on corporate profits, and so these surpluses keep building up. Then the question becomes, well, why can't we, the people, in the name of the general welfare, mobilize this huge volume of profit, which sits, of course, in banks? Apple is not simply sitting on that money. It's not under the mattress. It's sitting in a bank somewhere where it can gain interest. Especially since we know we have already socialized bank assets in this country. We have already socialized the banking system. Why not just go one step further and say, well, in the name of the general welfare, we need to redistribute this income. We need to mobilize all of this income in the name of job creation. And now, I say we've actually socialized the banking system already. What do I mean by that? Two things. First, we bailed out the banks. The big banks would not be standing today without our tax dollars. So, in effect, we are the shareholders. We are the stockholders. We invested in the banking system. We bailed it out. It seems to me we have to learn how to treat it as our responsibility as well. The second thing is, this has been true since the invention of the Federal Deposit Insurance Corporation in, again, I think 1935, if I'm not mistaken. We, the taxpayers, have stood as the guarantors of each other's deposits. We already own, in effect, these assets. The banks don't insure those deposits. We do as taxpayers. And if there is some crisis, the only way those deposits will be insured, that is to say we will be reimbursed for our losses, is because of our taxes. So in that sense, in both those two senses, we have socialized the banking system, and it's time for us to move one step further and say, okay, we should be in charge of the allocation of these assets.
I want to push you on two sides,
Okay.
Jim, just so you know where I'm coming. First is that the second is that I'm going to ask you, but isn't this a global problem? I thought most of Apple's money was sitting in Ireland somewhere.
Right.
They don't have any taxes. They're worse
Right.
than we are.
Right.
But before that, I want to ask you at the personal level. I'm older than you are,
Yeah.
and I have my pension.
Right.
It's like a 401k, pretty much. Are you telling me I need to act? Is this in my interest? Were there to be some major push for a change in the tax code which would redistribute? Aren't I cutting my own throat? That's what I think I hear from traditional economists, and I'm a senior citizen here.
Right.
I certainly don't want to do that. I don't think, or I want to know how much it's going to cost me if that's the case.
Well, I'm getting there. I'm almost a senior citizen officially. Next year I'll be 65. So, And I understand what you mean. I don't think, though, changes in tax code that would, for example, disallow the depatriation of profits. Like, in other words, Apple has shipped those
Right,
monies.
we'll get to that
Okay,
one
all right.
next.
But on the other hand, I don't think that corporate profitability actually drives the stock price to the extent that the traders and the analysts want us to believe. That is to say, their
So I'm
profits.
being hoodwinked.
I believe so. Yeah, by the banks. Now, I'm not necessarily the mutual funds. I mean, look, if you manage a mutual fund for Professor Rudy Bell, right, because you want him to be comfortable in his retirement, you're gonna try to balance that portfolio, but you're gonna have at least, I would say, 25% of it in a very aggressive stance where the profits are highest. You want that in a financial planner, it seems to me. But
Well, fortunately, I don't own any bonds in Detroit debt. I don't think.
That's a good idea.
Maybe they come cheap. I don't know.
Right.
It just feels to me like a huge mess. And I do sometimes think that I'm getting hoodwinked. And I'm looking here at the Main Street versus Wall Street.
Yes.
And in Dante terms, what did Wall Street ever do for me? Nothing. They never earned a nickel.
That's right.
On the other hand, they seem to be capable with their gyrations in the market on seeming to have a dramatic impact on.
The reason that
I didn't want to be a capitalist, but I am.
no, I understand, but I'll bet your mutual funds, I bet your 401k is not heavily invested in bank stocks. Whereas, as of now, 40% of the profits generated by corporations in the United States are bank profits. Now, why is that? What the hell is going on there? As far as I can tell, the only reason that the banks have become such a predominant force in the economy is, again, the surplus capital generated by the tax code amongst large industrial corporations, goods producing corporations. They don't need that level of profit, either for reinvestment purposes or for any other purpose for that matter. And so they hand those profits over to the banks. They don't need to go into the stock market to raise money. They don't, these corporations, they don't need to go into the bond market. If they actually want to improve capacity and increase productivity, most corporations, Apple included, can use their depreciation funds to merely replace their existing capital stock, and that's all it takes. They don't have to, in other words, make net investments, make additions to the capital stock in order to improve productivity or to increase their output. So, in that sense, these swollen profits that the industrial corporations turn over to the banks, and that the banks turn around and speculate with, they're superfluous, in a doubled sense. We don't need them to promote growth, that is to say, increases of capacity or output, and the banks themselves don't know what to do with this money. They're sitting on trillions of dollars as well, over and above the discrepancy between retained earnings and business investment in the larger corporate sector. So are you committing financial suicide by agreeing that we need a redistribution of income? I don't think so.
I'm going to leave that one for further student discussion.
Okay.
I want to get to another concern of mine, which is that this is a global problem, that you're focused on the United States in your book and your research and elsewhere.
Right.
But, I'm more familiar with what's going on among the pigs, Portugal, Italy, Greece, and Spain,
Right.
and their contrast with Germany and to a degree even with the more austere British,
Right.
and even the French.
Right.
And if you're willing to try to give us a quick look at Asia and Africa, I'd be more than welcome, but I don't have a lot. But I just have a feeling that nothing that the United States did, even if it were filled with courageous politicians who read your book carefully and understood fully its implications,
Right.
we would still be ensnared in a global, whether it's that the United States has Americanized the world or vice versa. But I don't see much hope in whatever it is that the Chinese are doing.
Right. I think I think you're right. I think to insist that we have to see this in global terms. And my sense of it, and I think most of the economists, at least, who write about the future of China or the future of the world economy, they all say the same thing about China, and that is that right now it saves too much. It saves over 50% of the income generated by economic activity there. That it needs to move from that kind of model to a consumer-led model.
Okay,
Consistent with this, yes. And I think one of the ways to think about my American focus is that I'm not suggesting that the United States is an exception, nor am I insisting that it's by no means an exception to the rules of historical development. Say. But I do think the United States is the indispensable nation in the sense that this is the future. This is what the future of the Chinese economy will look like. This is what the future of almost every economy out there, especially the ones that are developing and are saving and investing a great deal more of their income than we are. Back in the 1950s and 60s, Eastern European economists looked around in the post-war world, and they realized that there was a huge difference between the model of Eastern European development, that includes the Russia itself, but the Soviet model of development was what they called extensive development. And they saw that was the model of development that held through the Industrial Revolution and into the 1920s and 30s in the advanced industrial West, particularly in the United States, which they saw as the harbinger of the future. And they said, somehow between 1920 and 1940, the United States, and to a lesser extent England and France and Western Europe, had made a transition from extensive growth based on massive saving and investment to what they called intensive growth, based on the growth of consumer industries and the redistribution of income away from saving towards consumer expenditures. They, beginning in 1957, as early as 1957, these Eastern European economists, Vladimir Bruce is probably the most important, but Radoslav Siletsky is another, said, if the Soviet bloc doesn't make this transition from extensive to intensive development, it will stagnate. And they called it real exactly. They said by the late 1960s, this system will be in crisis, and within another decade, it will be on the verge of collapse. I mean, they saw it, they predicted it, and the Czechoslovakian Prague Spring was their way of experimenting with the alternative, intensive growth. Now, I think most people who study the relationship between, say, the United States and China are saying pretty much the same thing. That either China learns to make this transition from extensive development or growth to intensive development or growth, or it too will reach a crisis. Ben Bernanke, before he became the chair of the Federal Reserve System, he's the one who used to talk about what he called a global savings glut. And that's pretty much, it seems to me, the crisis of our time, this global savings glut. We are saving too much. We are investing too much. There's too much profit in the system, whether generated in China or generated here. And we have to change that if we're going to return to a system of balanced growth where the benefits of growth are shared between capital and labor, between wage earners and investors. So, yeah, but in that global perspective, the problem of Southern Europe begins to be, I think, a great deal more complicated a predicament than we even now recognize. So.
It won't get even more complicated if, in the end, and I want to get back to the idea that consumption is good for you from the book, but those who are doing the least consuming are the hundreds of millions of persons in Africa, in India, the more than 1 billion in China who are not excessive savers because they don't have anything to save. I read recently that the income inequality of Brazil is the fastest growing inequality in the world.
Faster than the United States?
Yes, faster, but that's because it starts at such a
All right. Okay. All right.
different base.
Okay. All right.
These, I mean, there would be fundamental redistributions of, I don't know, you comfortable with this notion that there's only so much wealth in the earth, whether it's oil or ability to produce food or anything else, and more for me is less for you somehow? Or
No,
you don't have the
I-
zero sum view?
no,
Okay,
I do,
good.
I do not have that zero sum view, but that it seems to me it amplifies the rationality of what I'm about to propose, which I think is consistent with what you're talking about. The redistribution of income I talk about in this book, away from capital towards labor, seems to me a way of solving the problem of growth. In the very short run, it solves the employment problem. And then it restores a balanced model of growth. But that redistribution, at least as I conceive it here, is not. It cannot be limited to the United States alone. We do have to redistribute income globally, away from northern civilizations, particularly North America, to African civilizations. And I think that's already taking place under the auspices of a great many NGOs and a great many, I must say, private corporations as well. I think the key to redistributing income away from the north to the south, if you will, excuse me, is to foster more and more and more cooperation between states, corporations, and NGOs. And I think it's absolutely essential. I've never believed, and this crisis proves, I think, even more so, that I've never thought that equality was a threat to economic liberty, to entrepreneurial energies or initiatives. It seems to me that this growing inequality in this country is creating a social crisis as well as an intellectual crisis that will become a political crisis. And then, when it reaches the level of political crisis, it's already an economic crisis. And meanwhile, we will have this ridiculous boom-bust cycle as long as we adhere to the idea that we must keep transferring income to the profit column so that entrepreneurs, the so-called job creators, can invest. We don't need them to invest. We just don't. And therefore, redistribution, it seems to me, is the only possible solution to our economic problem, but also to our growing social problem.
Tell me whether this means that our individual students should alter their spending habits, be proud of them.
Yeah.
Is higher tuition good for them?
Well, it makes them save more. I'm not so sure that's so good. I argue in this book that saving for a rainy day, that is to say, the deferral of gratification, is probably a bad idea. In large part because we don't have to anymore. And the more
Did
that
we ever?
Yeah.
Were you ever a
Oh.
fan of the Puritan ethic?
Oh, absolutely, yeah.
Getting back to some intellectual.
I think it did work. From, let's say, with the creation of those ascetic personalities that the Protestants invented, it did work. Greater saving was needed if growth was going to become something more than it was from, say, the 13th to the 18th century, which was pretty much of a flat line.
There's a big boost with the plague because
Right, exactly,
kill off a lot of the population.
That's
the rest
right.
are richer.
That's right.
The plague is good for you.
That's
Economic theories I know about. I won't bother.
That's right.
Burden you. But yeah,
Right.
things are pretty flat.
Right. And then in the 18th century, something miraculous seems to happen, right? We call it the Industrial Revolution. I mean, the increases in productivity and per capita income are just, they're
And the
extraordinary.
decrease in agricultural costs.
Exactly.
And that's huge.
Yeah. No, it's just, it's remarkable. So was a new burst of saving and investment crucial to the Industrial Revolution? Absolutely. I mean, I argue in my '94 book that the Civil War Reconstruction era was crucial in transferring resources from the consumer goods industries away from the consumer goods industries into the so-called heavy industries, the capital goods industries. And I think that exact transition drove the Industrial Revolution in England as well. So yeah, I think once upon a time, saving and investment drove growth, and I think we've got the numbers to prove that. But as many economists, my God, Robert Solow, Moses Abramovitz, Peter Temin, have demonstrated something happens in the 20th century, so that those three and many others as well argue that um, investment becomes less and less and less important as a driver of growth, and technological change, what Solow called exogenous technological change, that is, technological change not driven by market forces. That was the key to the extraordinary productivity growth and output of the 20th century.
Which, of course, is the history of Apple's profits.
Yeah, no, I would agree absolutely. So, but notice then how the very idea of investment is diminished. We don't so supply side economics, it seems to me, has been a lost cause, a lost 3 decades, because what the supply siders preached was transfers of income away from consumption towards saving and investment. That was going to restore the conditions of growth, they said, in the 1970s and 80s. Well, they were wrong. We did, in fact, transfer income away from labor towards capital, away from consumption to saving and investment. And what happened? We had growth, to be sure, but that growth was driven not by investment, but by budget deficits in the 1980s and by technological innovation in the 1990s. The net investment performance since the supply side tax cuts of 1981 and continuing into Clinton's decade in office, the cuts on corporate profits have made absolutely no dent in the long-term decline of net investment. So why do we keep doing it? Why do we keep thinking that we need investment? I think people like Solow and Temin and Abramovitz are right. Let's get off that fetish. Let's get off that obsession and talk about what really drives growth.
I was looking recently at, just Googled James Livingston, and you have a lot of very vicious critics.
Yes, I know.
And you show up in places and you argue back, which is wonderful.
Right.
I think that's just fine. I don't want to burden my students with watching all of your critics.
Oh, okay. All right.
So instead, what I'd like to do is to allow just a moment here for you to summarize how you see okay, I'll start and then you'll take it over.
All right,
Let's do it that way.
Okay.
So I think what I'm getting from my friend Jim Livingston, Professor Livingston, is that we need to focus primarily on full employment. We need to raise wages because people are then going to spend these increased wages, which is going to make the economy more robust. And even if they buy silly things like Christmas tree ornaments or iPads,
You saw the PBS.
yes. Well, we're gonna make the PBS
Right.
available.
Good.
Yeah, I think that's actually a very important statement.
Okay.
And that is what we can do best. And if, as I feel, it's sometimes hopeless to flail my arms at the world's economy and think that fundamental tax changes are involved in it, I see a growing consensus that full employment matters a lot. I see it in Italy, which I know best. I see it along the Mediterranean basis. I see it in emerging areas where the notion of employment in much of Africa is meaningless. Isn't clear what it means to be employed, really. But I think there is this sense that employment is the number one priority, and we get that figured out, and we get wages to be higher. There's a little movement afoot that even Germany ought to have a minimum wage. Imagine such a civilized thing. So I'm just seeing bits here and there that say that despite the vociferousness of the experts, some experts who are very upset with your book, nonetheless, that the wind shifts are there.
I hope you're right. I mean, one way in which you are clearly right is that when both sides of the debate now going on in Washington, both Republicans and Democrats say they keep chanting jobs, jobs, jobs. They both sides want to create more employment. The fundamental difference, though, and this goes back, I think, to what we've been discussing all along, the fundamental difference is that Democrats think that more public spending is the way to encourage, in the long run, more private spending, and therefore to increase employment. Whereas Republicans think that a retraction of public spending, what they call austerity, is the way to promote more private investment. I think the Republicans have not one iota of historical evidence on their side. There is no proof whatsoever that austerity works to create more employment. And if you look at Ireland, if you look at Italy,
Greece,
if
thank
you
you.
look
I
at
mean,
Greece, yes, right, or Spain, you will find that austerity measures, well, not only do they not work, they're destructive.
they're counterproductive.
Exactly,
Absolutely.
exactly. So I think that on historical grounds, the Democrats ought to be able to argue that they've got the better of the evidence. So yeah, I
If only history mattered.
yes, exactly. But I think you're right. I think there is this growing consensus that that's really the key to it. That we have to create jobs somehow, one way or another. Yeah.
Okay, that's
All
a note. We'll allow the students to disagree with that in the
Okay,
discussion
all right.
sections. They, I'm sure, will be very lively in viewpoints, but that's great. Thank you so
Okay,
much.
all right.